Hey everyone, it's Victor with BCM and welcome to part 2 of Learn About Options. In part 1, we went over the basics of options. If you're brand new to option investing, then I recommend you watch that video first to make the most of the second part. I'll put a link in the description below. In this video, we're going to take a closer look at calls and puts. We'll look at how the contracts actually work and then go over their benefits and drawbacks. We'll start by looking at a long call option, which is one of the most basic option positions. We'll look at how a long call works and also talk about why investors might want to use a long call. Next, we'll do the same thing for long puts, which is also another basic option position. We'll look at how it works and how long puts can be used. Then in part 3, the next part, we're going to talk about selling options and how that works. It's still pretty basic, but it does help to have a good understanding of how long option positions work before learning about selling options. A good way to visualize how options work is by using simple profit and loss diagrams. On this page, we have an example of a P&L diagram for a long stock position. A long stock position just means that we're buying a stock and then we're holding it. And that's what diagram 1 on this page is showing us. It plots profit or loss on the vertical y-axis and stock price on the horizontal x-axis. The black line with the arrow, that is the P&L function that plots profit or loss as a function of stock price. So in this example, we are buying 1 share of ABC stock for $100. And the diagram shows us that when the stock price is 100, so where x equals 100, our profit is 0. The y value is 0. That's because we bought the stock for $100. So 100 is our break-even price. At $100, we have 0 gain or loss. That's shown as the gray dot marked as break even on the diagram. Now, if the stock price moves from $100 to $120, so it goes from left to right, then we have a $20 profit or a 20% return. That's shown as the green dot for profit. If the stock moves from $100 to $80, so it moves from right to left, then we have a $20 loss or a negative 20% return. That's shown as the red dot, the loss dot. Now, in addition to those things, there's a couple of other important things to notice about this long stock diagram. First, notice that the upside profit potential is unlimited. Well, I mean, theoretically, it's unlimited. And that's because the stock price can theoretically keep going up. There's no hard upper limit. The second thing to notice is that losses are limited to $100. At least if we assume there's no borrowing allowed. Then in that case, our losses are limited to $100. That's because stock prices have a lower limit of $0. Stocks don't trade with negative dollar values. So now that we understand how a basic P&L diagram works, we can look at this for a long call option to see how that works. A long call position just means that we buy a call option and then we hold it. In this example, we are buying an at-the-money call option for $10 in premium when the stock is trading at $100. Now remember from part 1 that at the money means both the strike price and the stock price are the same. So here we are using $10 to buy a call option that has a $100 strike. Two important things to note here. First, remember from part 1 that option premiums are quoted on a per share basis, but each contract controls 100 shares. So if the premium is quoted as $10 per share, then the total cost of the contract is $1,000, which is just $10 times 100 shares. However, to keep things simple, we are just going to talk about everything on a per share basis in these examples. That's just so we don't have to convert back and forth, and it'll make it a little easier to follow along. Second, the stock prices on all of these diagrams will reflect prices at option expiration. Remember from part one that all options expire. So to keep things simple, we're just going to assume all of these P&L diagrams reflect stock prices as of the day of option expiration. That's because prior to expiration, all of these numbers and figures can change, but at expiration, they are final. They don't change anymore. So now looking at diagram 2, one of the first things you'll probably notice is that the break-even price is at $110, even though the stock price was at 100 when we bought the option. Remember in the long stock example, diagram 1, the break-even was at 100. The reason the break-even is higher here is because we have to pay $10 in premium to buy the call. So we have to add that $10 to the $100 strike price in order to get to the $110 value. 100 for the stock and $10 for the call. So our break even is 110, and that's shown as the gray dot. If the stock moves from 100 to 120, then we will have a $10 gain. That's just 120 minus the 110 break even. That's shown as the green dot. Now, at this point, some people may recall that the long stock position, diagram 1, had a $20 gain when the stock moved from 100 to 120. So why would anyone want to use this call that only produces a $10 gain? Well, there are at least a couple of different reasons. First, look at the left side of the diagram. That shows us the losses. There is a horizontal line at negative $10. That tells us that the most we can lose is $10. Even if the stock falls from 100 to 80 or 60 or even all the way to 0, we can still only lose $10 because that's all we paid for the call. In comparison with the long stock example in diagram 1, remember that the loss potential was dollar for dollar all the way down to 0. So the max loss with the long stock position was $100. At the same time, this call still maintains the same unlimited upside potential as the long stock position. That's shown on the right side of the diagram. Now, the call will make $10 less per share because of the premium cost, but it still has unlimited upside. So this profit and loss profile that has limited downside and unlimited upside can be attractive for obvious reasons, and it's also a common reason why investors will buy calls. Now, to be clear, I'm not saying that calls are always better than stock. There are other considerations. You've got the probability of profit, you've got dividends, you've got voting and control, and a bunch of other things. But I'm just providing a simple example and some reasoning as to why someone might want to buy a call. Another reason why someone may prefer a call is because the return on invested capital, which I'm just going to call simply ROI here, the ROI is higher for the long call than the long stock in percentage terms, not dollar terms, but in percentage terms. Now the call has a higher ROI because we only need $10 in cash to buy the call. Even though the break even is 110, we only need $10 upfront to buy the call. We don't need the full $110. On the other hand, to buy the stock, we would need the full $100. Well, I mean, technically we could borrow to buy stocks as well, but we're just going to ignore that for now. We're just going to assume that we have to use cash money to purchase. And if we do that for the call, we're going to end up making a 100% return on the call when the stock moves from 100 to 120. That's because if we take the $10 profit and we divide it by the $10 capital that we invested, that is 100%. On the other hand, for the stock, we would make $20 gain from 100 to 120. However, that would only amount to a 20% return because we had to invest $100 up front. So the call provides a leveraged return relative to the stock. One important thing to note is that the leverage cuts both ways. If the stock moves from 100 down to 80, the call will lose 100% of the invested capital. In fact, at any price below 100, the call has a 100% loss. Compare that to the stock. With the stock, if it moves from 100 to 80, that's only a 20% loss on invested capital. So, I mean, that was a lot to go over in a short amount of time, I know. So we're going to summarize all this information on the next page to clarify the comparison between a call and a stock. This table compares the stock to the call examples side by side. Looking at the table from top to bottom, left to right, notice that the call requires 10 times less capital to buy, and it has a loss that is 10 times less in dollar terms when compared to the stock. At the same time, the call still retains the same unlimited upside potential that stocks have. So again, this profit and loss profile can be attractive for obvious reasons, and it makes calls very popular for participating in upside. For example, a lot of investors will use calls, will buy calls as a way to speculate on price appreciation. Now, I say speculate because options are typically short-term instruments. They can be long-term as well, but most commonly they are going to be short-term, and short-term prices are hard to predict. They're very volatile. Sometimes they're totally irrational. And so trying to predict how a stock price is going to move in 2 or 3 weeks is fairly speculative. But still, it can be an attractive proposition and can make a lot of sense. For example, let's say we really like Amazon stock and we are very confident that it's going to move up near term. Now, in order to buy 100 shares of Amazon, currently we would need something like 250,000 US dollars. On the other hand, we could just buy an at-the-money call option, which also controls 100 shares, for about maybe 10 grand right now. And if we end up being right about the price action, we could make a substantially higher ROI on the call just because it requires so much less money. So that's that higher ROI potential. Now, calls don't have to be for speculating. They don't have to be used that way. Another common use would be, let's say, stock replacement. Let's say we want or need exposure to a specific stock, but there are restrictions that are preventing us from buying it, right away, for whatever reason. Well, what we could do instead is just buy an in-the-money call option to gain temporary exposure while we wait to enter the long stock position down the line. Long calls can also be used as a way to hedge risk. We can combine calls with other options or other stock positions to help offset or reduce portfolio volatility. So there are lots of ways to use calls. One thing I want to reiterate here is that long calls come with the risk of a 100% principal loss. To be fair, that risk is also present with stocks. We could lose all our money with the stock. But it is more prevalent with options because options expire. A call option that expires out of the money becomes worthless. Its value goes to zero, which could end up being 100% loss of capital, possibly even more if borrowed funds were being used. So just be careful, caveat emptor, buyer beware. Okay, next we are going to look at the opposite position to a long call, and that is just a long put. We'll cover this part a little quicker just because we already understand how a call works. And a put is really just the opposite, the inverse of a call. Now, before we get to that, we need to understand the difference between a short position and a long position. Up until now, we've mainly been talking about long positions. When we go long on a stock or an option, we buy it and then we want the price to go up so we can sell it for a profit. A short position is just the opposite of that. Going short means that we sell first and then we want price to go down so we can buy it back at a lower price for a profit. So we still want to buy low and sell high, but we're just doing it in reverse order when we short. Diagram 3 on this page is an example of a P&L diagram for a short stock position where we short the stock at $100. Notice this is just the opposite, the inverse of the long stock position from diagram 1. It's just diagram 1 flipped upside down. So here, if the stock price goes up, it goes from left to right, we're going to lose money. And if it goes down from right to left, then we're going to make money. That is a short position. A couple things to notice is that our break even is also at 100, so that's the same as the long stock position. But this ignores any costs related to shorting. Our maximum gain in this example is also 100 because remember, a stock price can only go down to 0. So the difference between 100 to 0, that's 100. That's our maximum gain. The loss potential, on the other hand, is theoretically unlimited because there is theoretically no upside limit to stock pricing. So if the stock prices keep going up, we're just going to keep losing money with a short position. Here on diagram 4, we have a P&L diagram for a long put position. Notice that it's just the inverse of the long call position from diagram 2. In this example, we are buying an at-the-money put with a $100 strike for $10 in premium. This put gives us the right to sell stock at $100. Now, because buying a put is really buying the right to sell, a long put is really a short position. That can be a little confusing because we're calling it a long put, but just think of it as buying into a short position. That's really what it is. Our break even here is $90 because the put option costs $10. So $100 strike minus the $10 premium gets us to the $90 break even, which is shown as the gray dot on the diagram. Now $90 is also our maximum gain because the stock can only go down to 0. So as the stock moves from right to left and goes down, we are going to profit dollar for dollar below our $90 break even all the way down to 0. So if the stock price moves from 100 to 80, our profit is going to be $10, which is $10 below the 90 break even shown as the green dot. On the other hand, if the stock price goes up above 100, we're going to lose our $10 in premium. That's shown as the red dot. That's true regardless of how high the price goes. So even if it goes from 100 to the moon, all we can lose is the $10 that we paid for the put. At the same time, notice the loss of that $10 is also a 100% loss in percentage terms. So just like the call option, a put option is going to provide leveraged profit and losses in percentage terms. This table summarizes a short stock position versus a long put. Similar to the long call example, this put has a lower capital requirement as well as a limited dollar loss when compared to a short stock position. In regards to the short stock position, one thing to note is that when we short stock, like in this example, if we were to short the stock at $100, technically we would not need to have $100 up front because the shares are borrowed. We borrow the shares. That being said, we technically would still owe $100 worth of stock at the time of shorting. And of course, the brokerage firm lending us the stock could also require some amount of collateral, but that's a different issue. I'm just using $100 here as a placeholder, okay? One thing to notice about a long put from this table is that both maximum loss and maximum profit are limited. The max loss is $10 and the max profit is $90. Notice that when we short stock, our loss potential is unlimited. And also, if we were to buy stock or to buy a call, remember from those diagrams, the gains would be unlimited. So a put is the only position we've looked at so far that has a defined range. There are limits on both ends, both sides. Another way to think about this is to say that a long put provides the most certainty. And it turns out that that is one of the main reasons why people will buy puts, why they use puts to increase certainty. Investors, a lot of times, they will buy puts as a way to ensure their stock price, to hedge their stock. So for example, if we own Amazon, we own Amazon stock at $2,500 a share, and we're concerned that the price is going to go down, it's going to fall, we could buy a put at, let's say, 2,400, so that if the stock price does fall below 2,400, the put will offset the losses from our stock position, right? So this is called a protective put, when you buy a long put to protect stock, a long stock position. And it's one of the most common uses of put options. Of course, people can also buy puts just to speculate on short-term price movements. They can use puts to maybe sell off a large chunk of stock in increments over time, according to a sales plan or something. Like calls, there are just lots of different uses for puts. And also, like calls, long puts that expire out of the money will become worthless. So buyer beware. It's always important to keep that in mind. Okay, so that wraps up part two. Here's a quick summary. A long call position is somewhat similar to a long stock position, except the call requires less money up front. It has a smaller loss in dollar terms, loss potential that is, and it can deliver leveraged ROI relative to the long stock position. Because of the P&L profile of long calls, they're often used as a way to speculate on short-term price appreciation. But it can also be used for other things, right? We talked about stock replacement, hedging, and so forth. A long put position is somewhat similar to a short stock position, but it has a smaller dollar loss potential. A short stock position has unlimited loss potential, remember. The put has leveraged ROI, and it also provides more certainty. Long puts are often used to hedge long stock positions because of the certainty that they provide, but puts can also be used for speculating on short-term price movements as a part of a sales plan and so forth. Regardless whether we're talking about calls or puts, just remember that all long options come with the risk of 100% loss of principal. Anytime an option expires out of the money, all of the premium is going to be lost. So that can result in a 100% loss. So that's just important to keep in mind anytime we are buying options. Thanks for watching. I hope you enjoyed the video or found it useful. If so, please like, subscribe, and share the content. If you have any questions or comments, just leave them below and I will do my best to respond. Thanks again for watching.